In this case, parent acquire a 40% associate, 40% significant influence. Therefore, we will use equity method. So the question says that the parent carries the investment in associate at cost in its own separate financial statements. Therefore, in this parent's own financial statements, you find that the investment in associate is already at cost, which is the investment cost, 600,000. 600,000 is the original cost of investment. Now it is already 31st of December 2003. The acquisitions was taken place on 1st of January 2002. So year 2, year 3, this is the second year after the day of acquisition. So therefore, on 31st of December 2003, we want to prepare to record for this investment associate using equity method. We have been told that the remaining useful life of the property, plant, and equipment at the day of acquisitions was 4 years with no residual value. So what does that mean? This means on the 1st of January 2002, there has been some fair value adjustments, actually only one. So the property, plant, and equipment's fair value is higher than the carrying amount. For the other items, the fair value is the same as the book value. So there has been a fair value increment for property, plant, and equipment. We expect that this fair value increment will be gradually reversed, will be gradually amortized throughout the remaining useful life of 4 years. 4 years is the remaining useful life. So this is for the fair value adjustments. In addition, there will be intercompany transfer, intercompany transaction. We have got one intercompany transaction last year. 2002 is last year. We have got one intercompany transfer for the current year, 2003. And we have got a intercompany transfer of property, plant, and equipment on 1st of July 2002. Notice the date. The date is 1st of July 2002. Now it is 31st of December 2003. So this 1st of July 2002 is the middle of the year last year. This is in the middle of the year, and therefore, depreciation adjustments will be made only for half year last year. If this is 1st of October, actually only 3 months. Right? So you must make the time apportionment. If this is not on the first day and the last day, right? You make the time apportionment. Again, we found a tax rate of 20%. Therefore, we have to account for the deferred tax implications, 20%. So we need to prepare the equity accounting entry. So equity methods means we initially record this at cost, and then we adjust for the share of profit and the share of other comprehensive income. So we know that there has been a fair value adjustment. There has been a fair value adjustment. So the fair value increment is 50,000. If this is a subsidiary, basically you should debit depreciation 12,500 and credit accumulated depreciation 12,500 every year, because this 50,000 should be amortized throughout the remaining useful life of 4 years, right? But this is not a subsidiary. We don't debit depreciations. Instead of debiting depreciations, we debit share of profit. The amount is the 50,000 amortized over 4 years after tax, and you share only your 40%. Therefore, every year, only 4,000 adjustments. This is the second year, so therefore, This is for the current year depreciation adjustments. And for the last year, we debit retained earnings. And in total, this represents 2 years adjustments for the accumulated depreciations. 2 years adjustments for the accumulated depreciation. Next year, we will accumulate for 1 more year. Right? Next year, we will accumulate for 1 more year. So therefore, if this is the 3rd year, you will debit share of profit 4,000, you will debit retained earnings 8,000, and you will credit investment associate 12,000. Every year, we add 1 more year. We understand that we need to add 1 more year every year, and we record the equity accounting entry from the day of acquisitions, because neither the investor nor the associate will record these adjustments. So therefore, every year, I will collect a new financial statement from the parent and a new financial statement from the associate. And parent and associate has not recorded these adjustments, and therefore I, being the consolidation accountant, I have to repeat all the consolidation adjustments, all the equity accounting entry that I made, because parent will not record, associate will not record. Understand? If the parent use equity method in their own book, then of course, in the parent's own financial statements, they have already recorded this equity method accounting entry, then I do not need to do anything. Right? But parent did not record. So I have to record everything from the day of acquisition. Okay? So therefore, I have to record even for the last year, right? Because no one has recorded. This is for the additional depreciation. Thereafter, we adjust for those intercompany transaction. Intercompany transaction. So we have got last year's intercompany transfer. Last year's intercompany transfer. Potentially, the overstatement of the inventory can be 60,000. So the potential overstatement of the inventory can be 60,000, but out of which only 60% remains. Only 60% remain. So therefore, the calculation will be, out of the 60,000, only 60% remains after tax, 1 minus 20% tax rate, and we share only 40%. We share only 40%. This is a transaction last year. Therefore, we don't debit cost of sales. We debit retained earnings because this is the cost of sales last year. We debit retained earnings. If this is a subsidiary, we credit inventory. This is not a subsidiary. We don't credit inventory. We credit investment associate. Right? This is not a subsidiary. We don't credit inventory. We credit investment associate. So this equity accounting entry 2 simply repeats what we have done last year. But at the end of year 2003, we have got a new information. We have been told that out of this 60%, 50% has been realized because only 10% remains. Only 10% remains. Therefore, out of this 11,520, 50% out of 60% has been sold. So we don't need to credit 11,520 that much. Out of this 11,520, 10% out of 60%, that means 5 out of 6 should be reversed. So therefore, we debit away 5 out of 6 of this 11,520. That means 9,600. So we debit investment associate 9,600. If this is a subsidiary, when we debit this inventory, you will credit cost of sales. But this is not a subsidiary. We don't debit inventory. We debit investment associate. This is not a subsidiary. We don't credit cost of sales. We credit share of profit. Very often, we may combine these two journal entries into one. So just like a subsidiary, when we combine these two journal entries into one for a subsidiary, you will debit retained earnings and credit inventory and credit cost of sales. How to interpret this? This means last year's unrealized profit, part of it remain unrealized, part of which has been realized. So crediting cost of sales means increasing profit. The same here for an associate. If we combine these two journal entries into one, you will debit retained earnings, 11,520. You will credit investment associate, 1,920. And you will credit share profit, 9,600. What does that mean? This means out of the unrealized profit, 11,520, 10% out of 60% remain unrealized. 50% out of 60% has been realized. Right? 1/6 remains, 5 out of 6 realized. It should be so, right? Because out of the 60%, 10% remains. Okay? This is for the last year's intercompany transfer. Now we have got the current year intercompany transfer. Current year. For the current year, potentially there has been an overstatement of inventory, 150,000. 150,000 is the potential overstatement of the inventory. If this is a subsidiary, you will credit inventory. But this is not a subsidiary. We don't credit inventory. We credit investment associate. This is not a subsidiary. We don't debit cost of sales. We debit share of profit. In terms of the amount, the potential overstatement of the inventory is 150. Therefore, we start from this 150,000, but only 30% remains. So therefore, we multiply with 30% remains. After tax, 1 minus 20% tax rate, and you share only your 40% as an associate. So therefore, you debit share of profit, 14,400, and you credit investment, 14,400. Even though this is a current year intercompany transfer, if this is a subsidiary, you need to debit sales and credit cost of sales. This is not a subsidiary. We don't need to debit share of profits and credit share of profits. Right? We don't need to debit and credit the same account, so no need to eliminate for sales and cost of sales for an associate. Actually, you don't consolidate the sales and cost of sales of an associate, therefore nothing for you to adjust. Okay? This is for the current year transfer for the inventory. Thereafter, we have got a transfer for the property, plant, and equipment. So we notice the fact that the net book value of the item was 80,000 at the day of transfer, and the transfer price is 120,000. So therefore, in the accounts of the seller, there must be a gain on disposal of 40,000. So on the financial statements of the seller, there has been a gain on disposal of 40,000. This gain on disposals must be eliminated. If this is a subsidiary, we will debit away the gain on disposal. If this is a subsidiary, we will debit away this gain on disposal. But this is not a subsidiary. We don't debit gain on disposal. Gain on disposal is a profit and loss item. Therefore, for an associate, instead of debiting gain on disposal, we debit share of profit. But this is a share of profit last year, because the disposal is on last year, right? Therefore, instead of debiting share of profit, we debit retained earnings. Understand? Right? So this debit retained earnings actually is a debit of the share of profit because of the gain on disposal last year. If this is a subsidiary, after we debit away the gain on disposal, you have to adjust for the cost and the accumulated depreciations. So we have to reinstate the cost and reinstate the accumulated depreciation. No matter this is for the cost of the property, plant, and equipment or for the accumulated depreciation, you are adjusting the balance sheet item. For associate, any adjustments for the balance sheet item, we simply credit investment in associate. Therefore, the adjustments is we will credit investment in associate. In terms of the amount, the gain on disposal is 40,000. The gain on disposal is 40,000. We don't share all, we share only 40% after tax. Right? So the gain on disposal is 40,000. After tax, we share only our 40% as an associate. Okay, so notice that this transfer of property, plant, and equipment occurred in the middle of last year. So therefore, there should have been a 1.5 years depreciation adjustments. So we sell it at a higher value. Higher value means we must have over depreciated. If we have over depreciated, we have to credit depreciations. If this is a subsidiary, you will credit depreciations and debit accumulated depreciation. But this is not a subsidiary. We don't credit depreciations. We credit share of profit. This is not a subsidiary. We don't debit accumulated depreciations. We debit investment associate. This is 1.5 years after the day of acquisitions. Therefore, this credit to the share of profit is for the current year, 1 year, and this credit to the retained earnings represents half year last year. And this represents 1.5 years adjustments to the accumulated depreciation. Right? 1.5 years. In terms of the amount, if there's no transfer at all, you think that the depreciation should be 20,000. Because of the depreciations, because of the transfer, the depreciation is now 30,000. So the difference is 10,000. We don't share all. The 10,000 difference in the depreciations, we share it after tax and only 40%. So every year, the adjustments is only 3,200. You can calculate this 3,200 as the difference between depreciations, but actually this 3,200 surely will equals to the adjustments for this gain on disposal throughout the remaining useful lives as well. So the adjustments for this gain on disposal is 12,800. You think that this is unrealized profit, so that's why you debit 12,800. But this 12,800 will be gradually amortized throughout the remaining useful life. The remaining useful life is 4 years. Therefore, this 12,800 will be gradually realized throughout the 4 years. That means every year 3,200. This is how we calculate 3,200 as well. Either way, right, both will give you the same result. Right, 3,200 is simply 12,800 divided by 4, being the remaining useful life. Okay, so now you have adjusted for all the intercompany transfer, right? Intercompany transfer. Now we start to share the profit. So from the financial statement of the associate, you find this retained earnings at the beginning of the current year. We share profit, and therefore we share this profit in the past, which is now retained earnings. The retained earning at the day of acquisitions was 120,000. The retained earnings at the day of acquisition was 120,000. Starting from the day when we acquired this investment associate, we can share their profits. So that's why from the day of acquisitions up to the beginning of the current year, we share their profits. So we share 40%, being an associate, we share 40% of the increase in retained earnings. That means 24,000. Therefore, we debit investment and credit retained earnings, 24,000. This retained earnings represents the profit in the past that we can share since the day of the acquisition of this investment associate. Okay, so we share this increase in retained earnings. Of course, we notice that there has been profit for the current years as well. Therefore, we share this profit after tax for the current year. The profit after tax is 160,000. We can share 40%. Therefore, we debit investment 64,000, and we credit share profit 64,000, just like normal. Right? We share the profit. So now we have shared the retained earnings and we share the profit already. Because we have already shared the profit, we notice that this associate actually pay out dividends. We share the profit already. Any dividend from the associate should not be regarded as a second source of income. Otherwise, you count the income 2 times. Dividend only come from profit. Therefore, because we have already shared the profit, any dividends that we have received from this associate should be debited away. So, in the parent's own book, in the investor's own book, they must have recorded a dividend income being 40% of this dividend paid. So therefore, we will debit away the dividend income that the parent has recorded in its own financial statements, and then we credit investment associate. When we receive dividends, the investment balance should go down. Right? Just like when I receive income, when I receive dividend from Hong Kong Bank, my investment balance should go down because they pay out investment. Right? You increase your investment when we share the profit already, so therefore any dividends will reduce the investment balance. Okay, so you have made 9 adjustments already. If the question asks for a worksheet, this is what you have to present, right? So this is the worksheet. So what we have to do now is, remember to insert an investment in associate under non-current assets. Under non-current assets, the answer template may not give you this item because it is not included in the financial statement of the parent and the associate, right? So this is a new item. So it is your responsibility to insert this item called investment in associate, which should be inserted under non-current assets. And then you post all the relevant items here, right? All the relevant items here. So you just post all your adjustments here. And you can achieve this 615,680. As I've said before, if you got this 615,680, if you can guess this figure, I will give you 5 marks. Okay, if you can guess. You are too lucky, you should get mark 6, right, instead of this. Right? So if you cannot get this 615,680, please give me the workings, each individual figures. Don't add the figures together. I don't know what figures you add together. Just give me all these 9 figures in the correct debit or correct credit. Each of them will give you half marks. Okay? So one thing I have to remind you is, actually, we don't need to insert this column for the associate. Nothing of this associate will be added together. You can see that for the share capital, we did not add this 200,000 here. It is still the 300,000. For the accounts payable, we did not add this 215,000 of the associate. We add only the parent. Actually, we add only the figures of the parent and the subsidiaries together because we consolidate only parent and subsidiary. We never consolidate an associate. Never consolidated associate means we never add the figures of an associate in our consolidated financial statement. So all these figures in yellow, right, in this column will not be added. Strictly speaking, we don't need to include this column here, right? But for examination, very often in the answer template, we'll insert it, right? So that if you add them together, you got everything wrong. Okay? So only parent and subsidiary will be added together. 100% of the parent will be added with 100% of the subsidiary, and nothing for the associate. Okay, so this is the balance sheet. So if the question asks for the income statement and the statement of retained earnings, this is what you have to post as well. So if the question asks for the income statement and the statement of retained earnings, actually after you post all this debit and credit and the total figures here, you should be able to get this closing retained earnings. The closing retained earnings is 3,515,680. You can copy this closing retained earnings to the balance sheet, right? This is the closing retained earnings. If the question asks for the income statement and the statement of retained earnings, actually, you don't need to post this debit and credit to the retained earnings here, right? So here we include all this debit and credit to the retained earnings, assuming that the question did not ask for the income statement and the statement of retained earnings. Therefore, you must post it here so that you can complete your balance sheet. If the question asks for the statement of retained earnings, actually, you can just copy these figures, 3,515,680 into here, which is the closing retained earnings. No need to post it 2 times. Even if you post it 2 times, I will count only 1 time. I will count in the income statement and statement of retained earnings if the question asks for this. Okay? But sometimes the question only asks for the balance sheet. If that is the case, remember to post it like this. Okay? So don't worry if you cannot get this retained earnings, 3,515,680 correct, and post it to the balance sheet, right? Because very often, most of the students cannot get it correct. Right? Don't worry. Right? If you cannot get it correct, still you may get full mark, right? Because the available mark will be more than the maximum mark. Usually we give some leeway, right? So if you got some mistake, right, depending on how complicated the question is, right? So if the question is very complicated, if you make mistake like 4 to 5 mistakes, still you can get the full mark, right? But if the question is not that difficult, maybe only 1 or 2 marks is the leeway, okay? But you can get the full mark even if you got 1 or 2 mistakes, right? Any question? Can you do so? You need to do investment associate in your midterm test, but not in the quiz in the coming week. Okay, so we got the investment associate 615,680. Sometimes the question will ask for an analytical check, or we call it reconciliation. So even this week, for the NCI, for the non-controlling interest, you will be asked for reconciliation. Reconciliation means you have to analyze it into book value of net assets, fair value adjustments, and the goodwill component. So that's why now we analyze this 615,680 into its 3 components. Slide number 28, book value of net assets, fair value adjustments, and the goodwill component. Book value first. Usually, we can get the book value from the financial statement of the subsidiary or from the associate. For this, we get it from the financial statement of the associate because this is an associate. So we check. We check the financial statement of this associate. So the latest financial statement of this associate show that the book value of the associate is 440,000. Of course, you can calculate the same using assets minus liability. So assets minus liability must be 440. So the book value of the net asset is 440. So we start from this book value of the net asset, 440. However, this is just the book value of the net assets reported by the associate. The financial statement of the associate did not take into account our consolidation adjustments. The same for a subsidiary, right? When we reconcile for the non-controlling interest, the book value of the net assets reported by the subsidiary did not take into account the consolidation adjustments. Therefore, now we have to make those adjustments. Say, for example, whenever you have got intercompany transaction, you may have made adjustments for the net assets. Say, for example, here, you have got last year's intercompany transfer, and then you say that 10% remain unsold. Therefore, you think that the associate's own financial statements have overstated the net asset. And that's why you have made an adjustment. You credit investment. You credit investments, that means you think that the net assets should go down. Right? The net assets should go down. Not only for this one, for the current year intercompany transfer, you think that they have overstated the closing inventory. And therefore, the net assets should go down by 14,400. right? 14,400. And then for this intercompany transfer of property, plant, and equipment, you think that they have overstated the gain on disposal, and therefore you think that the net assets should be reduced by 12,800. Right? It should be go down. It should be reduced by 12,800. But this property, plant, and equipment is a depreciable asset, out of which 1.5 years has been depreciated. So that's why we're always talking about the remaining portion of the unrealized profit. So that's why all these three adjustments will reduce your so-called book value of net assets. Right? So therefore, because of the intercompany transfer of the property, plant, and equipment, you said that 12,800 should go down. But 1.5 year has been depreciated, so the remaining portion is 12,800, 2.5 year remains out of 4 years. Next year it will be 1.5, and then 0.5, and then finish. We are always talking about the remaining portion of the unrealized profit. So this is for the intercompany transfer of property, plant, and equipment. This is for the last year's unrealized profit. Still remember, you said that 1,920 should go down. Right, should go down. And this is for the current year. You said that 14,400 should go down. So because of these three adjustments, so you got a debit, credit, credit, credit. So the book value of the net assets go down by the book value of the net assets has been gone down because of the three adjustments. So now the adjusted book value of net assets is 151,618. Okay? So we start from this book value of the net asset that the associate has reported, and we share 40%, and we do all these adjustments, right, relating to the intercompany transfer. For our associate, we adjust for all intercompany transfer, but only for our portion. If this is a reconciliation for NCI, remember, only if this is an intra-group transfer from a subsidiary, we need to adjust. If this is an intra-group transfer from the parent, we assume that it has nothing to do with the non-controlling interest. Okay? So therefore, next week, and also for the midterm test and for the final examination, remember, in the reconciliation of the NCI, only if this is an unrealized profit arising from intra-group transfer from a subsidiary, we need to adjust. Right? But for associate, all, right? Because we adjust only our portion for associate. So this is the book value of the net asset, after which we have got a fair value adjustments. Fair value adjustments. If you can still remember, at the day of acquisitions, you said that the fair value increment was 50,000. It was 50,000. But 2 years has passed, therefore 2 years has been depreciated. So the adjustment is 50,000, 2 years remains. After tax, 1 minus 20% tax rate, and you share only your 40% as an associate. Next year, it will be 1 out of 4, and then the year after, everything finished. Why these fair value adjustments will be finished within 4 years. The third component is the goodwill component. We haven't calculated the goodwill component yet. So long time ago, we know that at the day of acquisitions, we paid 600,000 to acquire this investment associate. We paid 600,000, On that day, we pay 600,000 and we get book value of net asset 320. This is the book value of the net asset at the day of acquisition. But there has been fair value increment. The fair value increment is 50,000. Right? So this fair value increment of 50,000 is a fair value increment before we consider deferred tax. So after tax, this becomes 40,000. So therefore, the fair value of the net asset after we consider deferred tax liability will be 360. Right? 320 is the book value of the net assets. Fair value adjustments is 50,000 after tax. This becomes 40. So altogether, the fair value of the net asset 360 after we consider deferred tax liability. So what we pay 600,000 minus what we get 40% of the 360 is goodwill. Actually, we pay enough for the goodwill component. When we add together book value of net assets, fair value adjustments, and the goodwill component, you successfully reconcile your investment associate.